Good evening. By all accounts, America is facing a foreclosure tsunami. 14% of homeowners in this country are currently delinquent on their mortgages. By the end of this year, foreclosure notices will have been sent to nearly 3 million homes, and a second wave is predicted. You're going to hear a lot tonight about servicers. It's a word that is used in the mortgage industry to describe where you send your mortgage payment. Wells Fargo is a servicer, as is Bank of America, for example. But servicer has taken on a whole new meaning to homeowners who are in trouble. The country's largest mortgage servicers have been battered in the headlines and on Capitol Hill for allegations of robo-signing and using fraudulent documents to foreclose on homeowners. But that could be just the tip of the proverbial iceberg with the servicing industry. A little reported and little understood aspect to the foreclosure crisis, claim consumer advocates, is that foreclosure is in fact a lucrative profit center for the servicers who are making millions off a laundry list of fees. The banks who service home loans dispute this, but we've been talking to homeowners across the country who say their servicers pushed them into foreclosure instead of working with them to modify their loans.
Brooke's mortgage payment was $1,500 a month. She tried to refinance, but she was underwater, meaning her home was worth less than the amount of the loan. But she heard of a new government program that promised to reduce the payments for 5 years just to keep homeowners in their homes and slow the national foreclosure bleeding. It's called the Home Affordable Modification Program, or HAMP. The government wanted banks, the same ones that had just been bailed out with taxpayer money, to return the favor and help homeowners like Belinda Brooks. But instead, many homeowners across the country say loan modifications have been a nightmare that's led them to financial ruin.
And in the end result, I might be moving out of my home, getting foreclosed on, which could damage my business, which ultimately could ruin me.
Belinda Brooks' story is similar to many we heard. But to understand what happened, you need a quick lesson in 21st century economics. Gone are the days of personal relationships between banker and borrower, as was depicted in the classic movie, It's a Wonderful Life.
Mr. and Mrs. Martini, welcome home.
Bread, that this house may never know hunger.
And wine, that joy and prosperity may reign forever. Enter the Martini Castle.
Today, there often is no relationship between the borrower and the lender. The banks that sold you the loan earned a fee for doing so, and then flipped it to Wall Street. Wall Street sliced and diced the loans and then sold them to investors around the world. Those investors own your loan, but the bank that sold you your mortgage is still in the picture, often serving as the middleman, collecting payments and deciding who and who does not get a modification.
So the bank doesn't actually hold the paper.
That's right.
But it services the loan.
It services a loan, and you don't have any control over who services your loan.
According to Diane Thompson of the National Consumer Law Center, that is a problem when it comes to modifying loans.
And so you're going to be making your payments to somebody who really doesn't have any interest in seeing you perform on that loan.
When Congress wanted to know about loan modification programs, they called Diane Thompson to testify, and she spared the servicers no mercy.
Servicers do not believe that the rules that apply to everyone else apply to them. This lawless attitude, created in part by financial incentives and too often tolerated by regulators, is the root cause of the robo-signing scandal, the failure of HAMP, and the wrongful foreclosure of countless American families.
Attorney Kenneth Graham to talk about this victory. Welcome to Balitang America.
Thank you.
Let's start with you, Attorney Graham. Why do you think this victory is very historic?
It's historic just because the banks have really gone out and trying to take advantage of people. And so Mrs. Palma, she worked hard trying to save her property. She thought that she had a loan modification. Everything was in good order. Then all of a sudden she got a knock on the door from a real estate agent telling her to get out. A lot of issues, and so part of that process, the bank didn't win this one.
Well, Attorney, there have been a lot of clients who've been fighting against the giant, the banks. But no favorable action yet, and this is the first case here that actually won. What did you do right? What is the winning ingredient here?
In Mrs. Palma's case, the bank simply didn't respond. They took over 9 months trying to figure out who actually held the note. They don't even know themselves who is the owner of the note. So it took them that long just to figure that out. It's still not clear who holds the note, and part of that process is the judicial system requires that somebody step forward and say that they own the note.
In this case, what's going to happen? The best case here, the best case scenario after this victory is that the loan will get modified?
The best case is December 3rd, the judge comes back and says that the bank has no further right to exercise this loan against the property, and Mrs. Corazona, Ms. Palma, gets the property for free.
Tonight we take a look at the recent mortgage crisis, foreclosure-gate, as some are calling it. It has been widely reported that there are a little more than 60 million home mortgages in the mortgage electronic registry system, or its acronym is MERS. If every one of the 60 million mortgages is worth $100,000, that would mean a total of at least $6 trillion in home mortgages that are electronically filed. In the mortgage electronic registry system, there is no physical written record of a promissory note. In almost all states, you need that original note to prove ownership of a home. That means in almost every single state, the banks cannot legally foreclose on your home without this document. Some say the loan documents were lost on purpose because the bankers did not want their massive fraud to see the light of day. Whether the notes were lost on purpose or accident, the original notes are nowhere to be found. That is what the robo-signing part of the story is all about. It has been widely reported that foreclosure mills were creating massive amounts of counterfeit promissory notes so banks could legally foreclose on homeowners. Rachel has more.
There are several layers of fraud and white-collar crime committed in this mortgage and foreclosure scheme. The lack of the promissory note is the biggest of all the problems in this chain of chicanery. Here's why. A promissory note is a financial instrument. It is in the same family as a Federal Reserve note. For example, if you copied a $100 bill and then tried to spend that copy in a store, let's say, because you lost the original, is it still money? Of course not. You would need the original financial instrument, here, a $100 Federal Reserve note, to make a legal transaction. The same is true for a promissory note. You need the original promissory note to legally complete a foreclosure. A counterfeit, or copy, of a promissory note is not a financial instrument, just like a counterfeit or copy of a $100 bill is not a financial instrument. Can you see how big of a problem this is for the banks? There is $6 trillion in real estate that fat cat bankers cannot legally prove they own. Also, it means trillions of mortgage-backed securities have no backing. I think this is the biggest financial fraud in history. This was not an accident made by someone pressing the wrong button or a few documents that weren't handled properly. It is fraud on a massive scale that took years and tens of thousands of people to pull off. Ironically, this is all playing out against a backdrop of outrageous Wall Street pay. This year the big banks will pay a record $144 billion in pay packages and compensation to their employees. Forrest?
Two very big things will happen because of this enormous financial fraud. 1. The banks are, once again, going to play the financial Armageddon card and scream for a bailout to save the world. You see, owners of all those mortgage-backed, or unbacked, securities will force the big banks to buy them all back. The big banks do not have that much money and, thus, many experts are predicting another monster bank bailout is on the way. How is that going to be paid for? With money printed out of thin air, that's how? I'll let you in on a little secret. It's already happening. The second big thing is that the banks will have to get tens of millions of homeowners to sign new promissory notes. Then, and only then, will the banks have the legal right to foreclose on homes, and the mortgage-backed securities will actually be backed. Jim Willie, of the Hat Trick Letter, predicts underwater homeowners will be demanding something in return for these promissory notes. Willie wrote, "The total $1 trillion bank aid package would cause a firestorm. A key provision to win over public support will be promises by the big banks to finally give home loan balance reductions. That will enable the American public to agree to the package, except 1 year later the American public will be shown more revolving doors and dead-end corridors. In other words, screwed."
If there was a question about whether we're headed for a second housing shock, that was settled last week with news that home prices have fallen a 6th consecutive month. Values are down nearly to the levels of the Great Recession. One thing weighing on the economy is the huge number of foreclosed houses. Many are stuck on the market for a reason that you wouldn't expect. Banks can't find the ownership documents. It's bizarre, but it turns out that Wall Street cut corners when it created those mortgage-backed investments that triggered the financial collapse. Now that banks want to evict people, they're unwinding these exotic investments to find that often the legal documents behind the mortgages aren't there. Caught in a jam of their own making, some companies appear to be resorting to forgery and phony paperwork to throw people down on their luck out of their home. More than half will get their mortgages adjusted, but the rest discover that they just can't keep their home. And for many, that's when the real surprise comes in. Turns out these banks, which demand borrowers have all of their paperwork just right, these same banks have fouled up their own paperwork to a historic degree.
In my mind, this is an absolute intentional fraud.
Lynn Simoniak is fighting foreclosure, and while trying to save her house, she discovered something we did not know. Back when Wall Street was using algorithms and computers to engineer those disastrous mortgage-backed securities, it appears they didn't want old-fashioned paperwork slowing down the profits.
This was the only piece where somebody was supposed to actually go get documents, transfer the documents from one entity to the other. And it looks very much like they just eliminated that step altogether.
Simoniak's mortgage had been bundled with thousands of others into one of those Wall Street securities traded from investor to investor. When the bank took Simoniak to court, it first said that it had lost her documents, including the critical assignment of mortgage, which transfers ownership. But then there was a courthouse surprise.
They found all of your paperwork more than a year after they initially said that they had lost it.
Yes.
Did that seem suspicious to you?
Yes, absolutely. And what do you imagine? It fell behind the file cabinet? Where was all of this? We had it, we own it, we lost it, and then more recently, everyone is coming in saying, hey, we found it. Isn't that wonderful?
But what the bank may not have known is Lynn Simoniak is a lawyer and fraud investigator with a specialty in forged documents. She has trained FBI agents. Curious, she used her legal training to go online and researched 10,000 mortgages.
Then I began to find the strange signatures.
One of the strangest signatures belonged to the bank vice president who'd signed Simoniak's newly discovered mortgage documents. The name is Linda Green. But on thousands of other mortgages, the style of Green's signature changed a lot. And even more remarkable, Simoniak found that Linda Green was vice president of 20 banks, all at the same time.
All within the same week. I mean, this is a very, very active person.
We went searching for the Linda Green, and we found her in rural Georgia. She told us she's never been a bank vice president. In 2003, she was a shipping clerk for auto parts when her grandson told her about a job at a company called Docs, D-O-C-X. Docs, once housed here in Alpharetta, Georgia, was a sweatshop for forged mortgage documents.
They were sitting in a room signing their name as fast as they possibly could to any kind of nonsense document that was put in front of them.
Docs and companies like it were recreating missing mortgage assignments for the banks and providing the legally required signatures of bank vice presidents and notaries. Linda Green says she was named a bank vice president by Docs because her name was short and easy to spell. As demand exploded, Docs needed more Linda Greens.
So you're Linda Green?
Yes. Can't you tell?
Chris Pendley worked at Docs at the same time and signed as Linda Green.
When you came in to Docs on your first day, what did they tell you your job was going to be?
That I was going to be signing documents for using someone else's name.
Did you think there was something strange about that in the beginning?
Yeah, it seemed a little strange, but they told us and they repeatedly told us that everything was above board and it was legal.
And your previous experience in banking?
None.
In legal documents?
None.
There really were no requirements for the job?
Correct.
You had to be able to hold a pen?
Hold a pen.
But you were signing these documents as if you were an officer of the bank?
Correct.
How many banks were you vice president of in a given day?
I would guess somewhere around 5 to 6.
What were you getting paid for this?
I'm embarrassed to say. $10 an hour.
$10 an hour, that's not much for a guy who's vice president of 5 banks.
Yeah, I was very underpaid for my status in the companies.
Pendley showed us how he signed mortgage documents as Linda Green. He told us that Doc's employees had to sign at least $350 an hour. Pendley estimates that he alone did 4,000 a day. This is also Linda Green. Shawana Kreit worked at Docs and says that she both signed and notarized the mortgage documents.
What was the role of the notary?
We were to make sure that everyone on the document was who they said they were and notarized the documents.
But the people who were signing the documents weren't who they said they were.
Right.
So if Chris Pendley was signing for Linda Green, you'd notarize that document?
Yes.
And you were told that was okay?
Yes.
What do you know now?
That it wasn't right.
The real Linda Green didn't want to be interviewed, but she said that some of the bank vice presidents at Docs were high school kids. Their signatures were entered into evidence in untold thousands of foreclosure suits that sent families packing.
So here's the same woman, Linda Green, and this time, instead of being a vice president of American Home Mortgage Servicing, she's vice president of a Bad Bean.
Simoniak says that the banks whose paperwork was handled by the Docs forgery mill included Wells Fargo, HSBC, Deutsche Bank, Citibank, U.S. Bank, and Bank of America. We contacted all of them, and each said that it farmed out its mortgage servicing work to other companies, and it was those mortgage servicing firms that hired